What if saving money is actually less valuable to a bank than spending it? It sounds strange. Banks tell us to save responsibly, build our accounts, and keep money safely deposited. But behind the scenes, the real money banks make comes from something else entirely. Stay with me until the end, and I promise you, once you understand this, you'll start seeing banks very differently. And if this hits home, don't forget to subscribe and leave a comment below. Part 1. The traditional idea of banking. Most people grow up believing something simple about banks. You put your money in, the bank keeps it safe, and maybe you earn a little interest for storing it there. It feels almost like a secure storage box for your money. Your savings account grows slowly over time. The bank protects your funds, and everyone benefits. But the reality of modern banking works very differently, because banks are not vaults. They're financial machines designed to move money, and movement is where profit happens. If money simply sits still inside an account, it actually does very little for the bank. What banks really want is activity. Part 2. Deposits are just raw material. When you deposit money into a bank, the bank doesn't lock it away in a vault with your name on it. Instead, that deposit becomes part of the bank's pool of available capital. Think of it like this. Your savings account isn't the final destination for your money. It's the starting point of a financial supply chain. Banks take deposits from thousands, sometimes millions of customers. Then they use that money to fund loans, mortgages, car loans, business financing, credit cards, student loans. All of those loans come from the same basic source, deposits. And once that money becomes a loan, something important starts happening. It begins generating interest income. Part 3. Where banks actually make money. Banks make money through something called interest spread. This is the difference between the interest they pay depositors and the interest they charge borrowers. Let's say the bank pays you 1% interest on your savings account. Then it lends that same money to someone else at 6% interest. That difference, the 5% spread, is the bank's profit engine. Multiply that across thousands of loans, and suddenly the bank is generating enormous revenue, which means something important becomes true. Savings alone don't generate profit. Loans do. Deposits are simply the fuel that makes those loans possible. Without borrowers, a bank cannot earn meaningful returns. Part 4. Idle money versus active money. From a bank's perspective, there are two types of money inside the system: idle money and active money. Idle money sits inside savings accounts. It doesn't move. It doesn't grow quickly. It simply stays parked. Active money, on the other hand, is constantly flowing through the economy. Borrowed money gets spent. Businesses invest it. Home buyers purchase houses. Consumers buy cars, electronics, and services. And every time money moves through lending, interest payments follow. For banks, activity is everything. A saver represents stability, but a borrower represents cash flow, and cash flow is what drives bank profitability. Part 5. Why banks encourage borrowing. This is why banks spend so much effort promoting loans. Mortgage offers, credit card rewards, personal loan advertisements, business credit lines. All of these products exist because lending is where banks generate consistent income. In fact, the entire banking system is structured around encouraging responsible borrowing. Savings accounts are important. They provide liquidity, they build customer relationships, and they supply the capital needed for lending. But if everyone only saved money and nobody borrowed, banks would struggle to operate profitably because idle deposits don't produce meaningful returns. Loans do. Part 6. The signal banks really watch. When banks evaluate customers, they look at something interesting. Not just how much money you save, but how you use financial products. Credit history, loan payments, spending patterns, debt management. These behaviors show banks something crucial: your ability to generate predictable financial activity. From a bank's perspective, a reliable borrower who pays interest consistently can sometimes be more valuable than a saver who rarely moves their money, because borrowers create recurring income streams, and recurring income is what financial institutions depend on. Part 7. the hidden reality of your deposit. So, when your money sits inside a savings account, it isn't just waiting there. Behind the scenes, it's part of a much larger financial system. Your deposit may be helping fund someone's mortgage, a small business expansion, a car loan, or a credit card purchase. In other words, your savings are often working somewhere else in the economy, even while your balance appears unchanged. And if you think your money just sits safely inside your bank account, wait until you see where your deposited money actually goes. That's next. After all, we are just asking, isn't it?